The three US Reit, Keppel US Reit, Manulife US Reit, and Prime US Reit have a lot of volatile in their share prices, and with the recent rise, they are still in the very low levels as compared to the past. So in this video, we'll go through their recent earnings and whether the share price justify their performances. So these three REITs are currently having a very high dividend yield because of a very low share price. So market are definitely pricing in risk involved. One example would be Manulife Reit, which has a very ridiculous yield of 20 to 30% before it actually cut off because due to the leverage spike. So what I meant by leverage spike is that when their debts suddenly rise while their asset valuation drops, it causes the leverage ratio to rise. So if you look at this formula, leverage ratio is equals to total debts divided by total assets. So if the total debts increases while the assets decreases, your debt ratio would definitely rise significantly. The drop in property valuation will be equivalent to the drop in the assets. For US office REITs, it's very particularly important to take note of this is because the performances of the properties would greatly affect the valuation as compared to other REITs where their property valuations do not fluctuate that much. Whereas for Manulife US Reit in particular, it's a prime example of the huge drop in their property valuation that caused their debt ratio to rise. So in this video, we'll take a look at the differences between the REITs properties and their performances. Now let's dive right into the first REIT that we will analyze, which is Manulife US Reit. So just by looking at the summary slides, occupancy is at 84.7%. while they mentioned that the average Class A offices is at 82.3%. However, quarter over quarter, they have actually dropped by from 85.1% to 84.7%. So this meant that occupancy are still continuing to drop for their certain properties, which we'll see later on. Rental reversion came in at a surprisingly high value of 24.2%. However, we are not to be too excited about it because it's just a rental reversion, so we'll see what is the reason why there's this huge spike, but occupancy still decreased quarter over quarter. So if you can see here, there's actually two aggregate or gearing ratios that they have actually shown, which is the MAS aggregate leverage at 56% while the unencumbered gearing ratio is at 59.9%. So what I'm understanding is that their gearing ratio of this is essentially referring to the debts that's unlinked from the assets. So in the event if they are default, these assets will not be taken as payment immediately as compared to the unencumbered assets which are tied to the debts. This meant that in the event if the REIT cannot pay the debts, the debt holders are licensed to actually take the properties away from Manulife US Reit. Because of this high gearing ratio that exceeds the limit of 50%, Manulife US Reit is no longer able to declare dividend until they repay or become less than 50% leverage ratio limit. Of course, with such a high leverage ratio, their interest coverage ratio is at a level of 2.4 times, which is quite low as well because the threshold is 2.0 times. So if you see from the second slide, the strong leasing came because of one customer. As you can see, the renewal is at 90.5%. And if we see the next slide, it shows the early renewal of the fourth largest tenant. So this might be one of the reasons why there was such a high positive reversion even though the occupancy dropped. Moreover, they are also mentioning that they are still modernizing the pitch tree using 18 million, which is expected to complete by 2025, which will also definitely help with the potential uplift of rentals. But to me, in this period, it's a concern that they are still upgrading their assets even though the leverage ratio is at a very high level. So if you look at their snapshot of the debts, their interest coverage ratio dropped from 2.6 times to 2.4 times. Of course, they have mentioned that they are actually cutting down on their gearing ratio, which is still at a very high level. Average interest of debt rose from 4.1% to 4.38%, whereas the fixed rate loans dropped from 80.2% to 69.2%. So my concern in this period of high interest rate is that because of the weakness in the sponsors, and definitely the weakness in the performance of the REIT. New loans would definitely be refinanced at a higher rate because lenders would deem Manulife as a more riskier borrower to lend to. So there are actually already 3 things that is actually hitting Manulife that is preventing their leverage ratio from dropping so quickly. 1. The drop in the asset property valuation due to the continuing decreasing of the performance of their properties. 2. Their cost of debt would definitely rise when they have to refinance the debts. Of course, lastly, if the decrease in the performance, they will have lower property income, therefore lower income to pay for the debts. And you can see from their debt profile, the total debts add up would be 1,023 million of debts. So in order to bring down 9.9% of this to become 50%, gearing ratio would essentially have to bring down additional 101.27 million. However, things are not so simple. If you can see, there's 2 different kinds of loan. Firstly is the trust level green loans or sustainability linked loans. Second, trust level revolving credit facilities and other term loans. So if you see, these revolving credit facilities is very important because like the term says, it's a credit facilities. These facilities is important because it gives the REIT a luxury of having a fixed amount of flexible loans that they can borrow. So this amount is actually determined annually by borrowing companies. Usually these kind of loans are unhedged, therefore taking them during high interest rate environments is definitely riskier. However, because it's flexible, REITs can borrow and pay them back as and when is required. For in this case, 141.7 million plus 79.3 million is actually the revolving credit facilities. This amount would definitely not be fixed rate loans. Looking at their properties and comparing the vacancies from the last quarter, those that are highlighted in yellow actually didn't move much, maybe plus minus 1%, whereas for the red amounts, they actually have a larger drop. As you can see, the net absorption for actually this in particular property has dropped by 216,000 square feet, whereas for this Temple Phoenix has dropped by 208.5 thousand square feet. To me, this is a huge concern for Manulife US Reit because like I said at the start of the video, the performance of the properties would actually determine their property valuation that will be occurring at the end of the financial year. So next quarter would be their end of the financial year and the property valuations would have to be updated, and expect it to continue dropping in the worst case because based on the current revenue, they are actually on par with Prime and Keppel Pacific Oak, while Prime and Keppel Pacific Oak assets is actually priced lower as compared to Manulife US Reit. So property valuations will be one of the key factors that the management will have in order to reduce their leverage ratio. Alright guys, before we continue, I would like to talk about a new broker that I've been using, which is Webull. For the remaining month of December, by opening an account and funding any amount and maintaining it for 30 days, you can get 10 free shares worth $30 up to $5,000. You can even get additional rewards by actually funding over $2,000 and putting it into their Money Boo section. By depositing 2,000 USD and maintaining it in Money Boo until 31st Jan of 2024, you can get additional cash voucher of 80 USD on top of the interest that you earn. If you deposit more than 100,000 and maintain it until 31st March of 2024, you can get an attractive cash voucher of $3,000 on top of the interest earned. So sign up with Webull account with my link today. Thank you, and let's continue on with the video. Next, let's go on to Prime US Reit. There are good news for Prime US Reit because Q3's leasing is more than Q1 and Q2 combined. Moreover, they have said that there's a good momentum going into Q4, so hopefully we expect the revenues to improve. Occupancy held stable at 85%, whereas one of their tenants also have their lease extended. The risk is that their leverage ratio is at 43.7%, while their interest coverage ratio is at 3.2 times. Unlike Manulife, Prime US Reit has actually given financial updates for Q3. Gross revenue decreased year over year by 0.9%, NPI decreased by 3.3%, while distributable income dropped by a huge value of 23.4%. So this is common for all REITs because due to a higher interest rate, more of their net property income will have to be paid to the debts, therefore lower distributable income to shareholders. And their income available for distribution, of course, dropped by 16.6% year over year. However, the good thing is that this 14.7 million is actually stable for quarter over quarter. So hopefully this might be the end or the lowest point for Prime US Reit to turn around. For their credit facilities, they're actually broken down into different types of debts for the different periods of maturity. So the biggest loan will be the main credit facilities from Bank of America. So as you can see, that's quite complicated because there's term and there's revolving credits. My understanding is that the term loans are the loans that have been taken, while the revolving credits have an amount that is undrawn that can be used at any time as well. As you can see, the facilities available is 200 million while the outstanding principal is 84 million. This actually meant that more credit facility was drawn as compared to last quarter. However, the good thing is that they have mentioned that they have 161 credit facility lines that is undrawn, and that can be actually calculated by looking at the 3 revolving credit facilities, which when you sum the 3 of them up, which will give you 161 million. So this credit facility is important because in the event if Prime US Reit need cash, they can actually draw from these credit line facilities. So if you look at their occupancy and tenancy expiry of their assets, they have quite a few that is expiring in 2023 and 2024. So we have to see how or is there any improvement as time passes, because they are actually proactively focusing on addressing these expiries. So if we look at the occupancy, those highlighted yellows are not much differ or changes, whereas the red one to focus on the 2 assets, which is one Washington Center and Village Center Station 1. However, the good thing is that they have said that encouraging signs of leasing activities are emerging from these 2 properties. So we will see next quarter if this occupancy actually improves or if the management actually mentioned anything about it. But the rest is definitely still quite decent as compared to Manulife US Reit. Now let's go on to the last REIT, which is Keppel Pacific Oak US Reit. Now for Keppel Pacific Oak US Reit, it's quite interesting because their performances as compared to Prime US and Manulife US Reit is different. So if you can see from the slide here, based on their performance year over year, there's actually a surprisingly increase of 3.3%. Net property income also increased by 3.3%. Their distributable income, although dropped by 10.7% year over year, however it's slightly at a consistent rate of 13.1 million. So just to give you a context, the previous assumption was that they might have a drop in the distributable income. However, with this current value of 13.1 million, and if they keep it consistent for the next quarter and comes in at a total of the previous quarter, which is 25 million, Keppel Pacific Oak Reit would be assumed to be able to give the similar dividend as the first half of financial year 2023. And this will be a very good news because at the share price of 28 cents at the time of recording, the dividend yield will be 17.8%. So it's much better as compared to the previous assumption that I made, which is more conservative, where I assume that in the event if their distributable income drops to 10 million, they will have a payout of $19.20 per lot instead of the $25 currently that is predicted. So that's why to me, Keppel Pacific Oak Reit is one of the rare ones that is outperforming as compared to the rest of the US office REITs. Now next, looking at their debts, they have quite a lot of credit facilities that is still available to be used to pay off their debts. However, if you see, they only have a slight amount at 1.7% for 2023, while the debts in 2024 is only required to be paid at the Q4 period. So why is this good? Is because my assumption would be that in the next year, interest rate would start coming down, and because of that, the refinancing of these debts would be less severe as compared to refinancing the debts now. Of course, one of the risks will be that if the interest rate do not come down, then this huge bunch of debts would definitely be a problem for Keppel Pacific Oak US Reit. Currently, there's no issue because inflation is coming down in the correct trend, and Federal Reserve have consistently hinted at Fed pausing and Fed cutting rates in the near future. The next interest coverage ratio is at 3.3 times, which is still a decent value as compared to the rest, with a leverage ratio of 39.1%. Now let's look at their property occupancy. So like I said previously, property occupancy, especially for US office REIT currently, is very important because it determines the property valuations. If your occupancy drops, valuators would deem the property as less valuable because it's less attractive. So therefore, a drop in the occupancy of course will lead to a drop in valuation. However, if you see the recent results here, the good thing is that Keppel Pacific Oak has turned around the occupancy. With instead of a decreasing trend now, they have actually had a surprising increase from 90.8% to 91.4%. So you can see from this screen here, the highlighted green ones are the ones that's increasing. And like I said during my previous analysis for Keppel Pacific Oak, Seattle properties is the most important because it holds the largest property income for Keppel Pacific Oak. And you can see that they are all in the green. Whereas the yellow ones are the stable ones and the red one is actually the smaller ones. However, it's still good because overall everything is in either the green or the yellow. Okay, so as they have new tenants, it's important to look at their rental reversion because it determines the increase in the renting asking price per the new tenants or the renewal of the tenants. So if you can see, the in-place rents is at 0.4% below the asking rent. But if you see, the negative rental reversion was due to a major tenant that was asking below. Without it or excluding that major tenant, the rental reversion for Q3 would have been a positive 3.8%, which is still quite decent. As if you know, currently the US office market is not so good. So being able to maintain the occupancy, the income, would be a very impressive thing because at the very low share price, you can get a very high dividend. And in the future, as things improve, I feel that people will still have to go back to office and office spaces would come back in demand. Another good thing that I've previously missed out is that if you look at their first choice sub-market outlooks, this Seattle property actually has under construction quite a lot of spaces which is catered for customer, and that is actually for Amazon and Microsoft respectively, where they both have actually catered spaces for these big companies, and that's good because this actually meant that this amount of space is guaranteed to be occupied in the near coming future once the construction is done. I hope this video brings about more insights into the differences in the performance between the three US REITs. And because their share price are at a very low level now for all three REITs, there is actually investment opportunities here to invest in. Of course, there are definitely risks involved, but with the right following or the right analysis, I feel that this will help to mitigate the risk and it will give you very good rewards. So if you like this video, please hit the like, comment and subscribe on what you feel about the performances of these three US REITs. Thank you, and I'll see you in the next video.